My name is Iris Chung, and I'm from the SALT group. And today we have a great lineup for you on discussing the sales tax landscape. Our goal is to inform you of the sales tax landscape so that you are able to make sound business decisions. Today we have David Casper. He's not listed on the presenters, but he is a core part of our SALT group. He'll be joining us in my presentation. And on the technology side, to show how you're going to become compliant, Bridget Merton, who's a Senior Strategic Alliance Manager with Avalara, is with us today, as well as Kelly Williams, who is a NetSuite Associate with Eide. Let's get started. And bear with me as these slides move a little slowly with our technology today. To give you the landscape of sales tax, I think it's good to get an understanding of the history, because sales tax is so unusual in that it actually is dictated by Constitution and the Due Process and Commerce Clause provision. So I'm going to go back before 1992 and just give you a brief synopsis of Due Process and Commerce Clause. Due process basically curtails government performance so that it's fair, fairly applied, and regulates the states in how they can tax taxpayers, out-of-state taxpayers and in-state taxpayers. And the Commerce Clause is basically where the Congress has power to regulate interstate commerce. And you might be asking, well, how does that apply to sales taxes? Well, within that, through Supreme Court cases, it has also been implied that it also regulates state powers' imposition of taxes on interstate commerce. And that's called the Dormant Commerce Clause. It's implied, it's not stated in the Constitution in the Commerce Clause, but that is the regulation around sales tax that the Supreme Court has basically set thresholds and bright line tests throughout cases over time. So let's fast forward to 53 years ago. This isn't on your slide, but in 1967 was one of the first pivotal cases in sales tax, and had to do with Bellis Hess. So you might be wondering what that is. Well, that was a mail order catalog company that was based in Missouri, and it had customers all throughout the US. This is the way that commerce started. And keep in mind that sales tax is a transactional tax. So mail order catalogs are similar in our technology today. It's the internet, but at that time it was mail order. So not much has changed over time. So at that time, the Supreme Court said, well, we don't want to burden all of these businesses with collecting all of these various state taxes across the US, so we're going to apply a physical presence test and say that the Due Process and Commerce Clauses, the NEXUS requirement is physical presence. So 25 years later, Quill is the 1992 case on your slide. In that case, the Supreme Court said, well, Congress has the power to regulate interstate commerce. We don't want to interfere with that, but they can't take away due process protections from out-of-state taxpayers. So we'll say that basically the sales taxes imposed on out-of-state sellers meet due process. They're not in violation of due process. So the Commerce Clause, though, requires substantial nexus, and substantial nexus means substantial physical presence. Fast forward 26 years later, to 2018, 2 years ago, with Wayfair. Congress didn't act. There were marketplace legislation that had been in play for years, but 26 years had gone by and nothing had happened with Congress. So the Supreme Court took an additional step in Wayfair, where the South Dakota state actually enacted a law that said that $100,000 in sales or 200 transactions exceeds the NEXUS threshold, allowing the state of South Dakota to tax remote sellers. So the court said that this threshold, throw away physical presence, this threshold prevails. And they overturned the last two cases of Bellis Hess and Quill. The court's discussion was very concerned with South Dakota, which relied on its sales tax because it doesn't have an income tax, that the physical presence test was eroding the South Dakota tax base, that physical presence was removed from economic reality, and it had no real relation to the economy today. But in reality, internet sales was just like catalog sales. So now with another layer of economic nexus determinations to create a filing requirement for out-of-state sellers, the physical presence test is still alive and it still creates nexus, and we'll show you why that's still important. So what is nexus? What is the nexus requirement? It means a connection that an out-of-state business has with the state. There's different types of nexus. There's click-through, which in today's world, that's the internet, where you might surf on, let's say you're surfing on a website called Buy My Stuff. Buy My Stuff has a referral to another website for another business that might sell accessories that are complementary to the Buy My Stuff website. So you click through and you purchase an item on that second tier website. That website has, that business has nexus in the state that you're buying in, state X. New York actually tried to impose, they came down with a law before Wayfair to impose tax on those internet sellers. Cookies are web cookies that when you provide information when you purchase, or not even before you purchase, but on an internet website, your personal information, your preferences, that information sits on your browser. Then when your cookie, then the cookie gets sent to the server, and then the internet website will come back with a customized page. Affiliate nexus is if you engage a third party, a company, to do some repairs, let's say on a product. So you have third party independent contractors that go in and do repairs on your own. Physical is when you have physical presence in the state. Going back, affiliate can also be a third party that does other services as well. And economic nexus is how the thresholds were established in Wayfair, where you have a sales threshold or you have a transactional threshold. So this is a more detailed explanation of what physical presence is. Like I said, physical presence still has a significant, this is a significant consideration still, because once you have physical presence, either through a third party, another example is a third party providing warranty repairs, or you actually do go into the state, let's say you sell a product and then afterwards you do some installation work, or you're delivering goods by company-owned or leased vehicles, that still matters. And if you do not exceed the economic presence numbers of 100,000 or 200 in transactions, you are required to file. Economic presence, like I said before, has to do with the $100,000 and $200 transaction thresholds, which are general thresholds. States vary in what those thresholds are and how they are applied. Common nexus triggers. For a fast-growing company, especially one where employees work remotely more often, payroll is a trigger, and it's a trigger that should be evaluated every year. It changes year to year. Your remote employees move. There's transitions in the company. So that's very important. Warehouses. Warehouses for a growing business, you may establish a warehouse on the West Coast, on the East Coast. So as soon as you're establishing a warehouse in a new state, you'll have to look at registration and all the other requirements and how you might need to file. Property. One big question that comes up with technology companies is, what if we engage Amazon Web Services for putting our servers, putting our information into the cloud? There may also be actual storage of information on servers that Amazon may provide space on their servers in different locations throughout the state, throughout the US, in different states. So does that create nexus for your company? Inventory revenue, again, that's the economic nexus threshold. So these are very common nexus triggers and items to be aware of as you're growing your business. So here's a question. Do we have nexus? A machinery dealership sells a product delivered by common carrier into Washington. The contract price for this single item is $500,000. Does this company have nexus? The Washington economic nexus threshold for sales and use tax is $100,000. Now that seems obvious. They do. It's measured solely based on economic nexus because they do not have a physical presence in the state. What happens if this was one sale and they don't anticipate doing another sale? Now, practically speaking, if we're talking about a retailer may find it difficult to project whether they're going to have a customer in a particular state. These are large pieces of machinery, but it's hard for them to forecast whether they're going to enter a state one year and maybe not enter in the subsequent year. So once a company is registered, it's very difficult to unregister. And one of the reasons why is because there's a trailing nexus concept, where for 6 months to maybe a year and a half to 2 years after a company deregisters, the state can consider any sales within that period of 6 months to 2 years to be subject to tax. So as a result, practically speaking, a business may want to continue filing. Now, where would this not apply? It may not apply in the situation of a contractor that actually performs huge construction projects in different states. In those cases, it's a cleaner project situation to say that perhaps you do not register in the subsequent year because you don't have a contract in those states. And then you would consider registering, you would need to register in the states in which you do have contracts. So that's an example of the complexities and considerations that a business may want to look at. That's a fancy transition. So now we have another one. California, Arizona retailer sells merchandise shipped by common carrier to California customers. The contract price is $100,000. Do we have physical presence? The answer is no. So then we're measured by an economic threshold. And California's economic threshold for sales and use tax is $500,000. So obviously, we don't. So a point of consideration is that you would need to monitor your sales year to year and see whether you exceed those thresholds and whether you're close to those thresholds. Because once you do hit the number, and let's say your sales decrease in subsequent years, the state can go back and look at that year in which you triggered and exceeded the economic nexus threshold. And at that point, you would have had a filing requirement. Polling question number 1. What are the types of sales tax nexus? A, physical and economic. B, cookie, click-through, and economic. C, physical, economic, cookie, click-through, and affiliate. D, none of the above. 79% got it right.
Question that I get probably the most, and that is, am I really a remote seller? Because a lot of us have been doing business our own way for many years. Well, I just take phone calls and I sell things. I'm not a remote seller. That's only for the internet people. Probably some fax machines still out there, maybe. Internet download. That you can be a remote seller by internet download or online order forms, any number of things. The simplest way to figure out, do I have remote seller issues, is if UPS is coming to your door and you're sending things to other states, you are a remote seller. If you're providing software or videos that are downloaded into other states, you're a remote seller. If you're providing software as a service, you might be considered a remote seller in about half the states in the country. Pretty much everyone but the Starbucks on the corner is a remote seller. Now, how far that remote seller activity goes is a different topic. So here we are, beautiful downtown Lexington, Texas, home of Snow's Barbecue. This looks like a place that is not a remote seller. And the people there are so good at what they do, like a lot of people in the business world. They just do barbecue. They do barbecue to the point where people are lining up at 6 o'clock in the morning. At 7:30, I witnessed an entire bridal party from the night before showing up to stand in this line for barbecue. They can't be a remote seller. Well, that's what most people would think. But if you go to their website, and you can order directly online, barbecue shipped to you next day air, right from their web page. Order some now. They are a remote seller. There's another steakhouse in Texas I've been told of that sells beef briskets delivered next day air around the holidays, and they sell thousands of them pre-cooked and ready to go. As you can see, pretty much anybody can be a remote seller. You don't have to do a whole lot to be considered one. You know, this is the sort of a quiz question. You know, are the folks in that picture, are they pitmasters or are they remote sellers? Well, you can go to their website. You can buy sauces, coffee cups, t-shirts, barbecue delivered overnight. And you can order that by phone or on the web. Yeah, I bet you if you mailed them a letter with an order in it and some cash, they'd probably take it that way too. So technically, our folks at Snow's Barbecue are remote sellers. So what we get is great. Maybe I'm a remote seller now. All right. Now, do I have to register in every state if I'm a remote seller? And let's just presume that we've never left home, or in the case of Snow's, that we've never left Lexington, Texas. We haven't put boots on the ground in other states. We haven't hired people to do things for us in other states. We're just on the corner in Lexington, and we've got some pretty good sales by phone fax machine, letter, whatever it takes. Do I have to register in every state? Well, that goes into what Iris, Iris was discussing economic nexus types. Well, of course, all the 45 states that have a sales tax, everybody has to be a little different. And in the kind of chaos post-Wayfair when states were posting their requirements, the interesting thing was they all fell into like 2 main categories and then a couple of stragglers. So it's not as hard to work through as you might think. There's quite a few states that fall into what I call the only group. They just look at dollars in sales. Did you make 100 grand worth of sales into my state? I don't care if they're wholesale or resale. 100 grand. If you have crossed that, you need to register. If of that 100,000 you sold, 95 or $99,000 was wholesale and you had resale certs for it, we don't care. You still need to register because we want the tax on the $1,000 that was not for resale. The OR group, that's a much smaller number now. That has since decreased. That was approximately 100,000 in sales. That's what they're saying. Or if you had 200 transactions. The problem with that one, and that's why a lot of states have just changed to a straight dollar amount, is there are a lot of small businesses out there that sell $8 items and send them by US mail. They could have just minuscule tax amounts and still be required to register and collect. So only just by a straight dollar amount is the most common. ORs are second place. I want to say there's maybe 3 states that are in the AND category where they're looking for so many dollars in sales and you had to do it in 200 invoices. And the last one that's really sort of just falling off the table right now, there were a few states out there that said you could either collect our tax or there's some reporting requirements that we want you to go through. Short version on those is the reporting requirements are so difficult, you are better off just registering, but that is a business choice. Think over 45 states with a sales tax, there's maybe 3 that haven't passed the law yet. But as you can see, the most common numbers in the ORs are 100 grand or 200,000. Excuse me, error. 100,000 in sales or 200 transactions. Some apply this to tangible goods only. Some say it also applies to digital property. That's some hair splitting that happens after. But the pattern here is $100,000 in sales into that state. Now, I had 2 AND states. Now you'll see New York is an AND state and Connecticut is an AND state. You could have 300 transactions in Connecticut, but if your total was under 100,000, they don't expect you to register. New York, you could sell $2 million in there on 2 transactions, but if you didn't cross the 200 or the 100 transaction threshold, they're not expecting you to register. That is kind of a business decision once you get to that point. If the dollars are large enough, a lot of people, they've already set up, they're collecting tax in a number of states. They just decide to add on one more state just to be consistent across the board. And we've got some more here with a little bit of a twist in them. Like Arkansas says taxable gross revenue. Nebraska says only applies to property that's being shipped, so it may not apply to digital goods. You have North Dakota that says it's taxable gross revenue. I didn't see it in the statute, but if you go to like the North Dakota website, they are looking for $100,000 of taxable sales in their state. They don't care about sales you're making for resale. There are some ins and outs with that. You can see like California's gone to a larger number of 500,000. Alabama's at 250. I believe Texas is at 500. But the main takeaway on this is, if you haven't done it already, try to figure out how to track your states by ship to state, and just keep 100,000 in mind.
Thank you, David. As we move on to the next slide, I have another question. On Texas, their NEXUS threshold started on October 19. Gross revenue threshold is 500,000. And this taxpayer retailer has Q1, $350,000 of sales, Q2, 100,000, Q3, 100,000, Q4, 50,000. When has this taxpayer reached NEXUS? In Q3, in the middle, essentially in the middle of Q3, they had over $1 over $500,000. That would trigger a filing requirement because they would meet the gross revenue threshold. Practically speaking, the taxpayer may start filing in Q4 or in Q3. So that again is a decision that the company would make, but that's how the threshold would be measured. And states like Texas would look at the past 12 months. And obviously here, with not even to 12 months, the threshold was exceeded. On the next slide, we have another example. Same Texas, effective date, October 19, gross revenue threshold, $500,000. So it's a retailer, but some of their sales aren't taxable. Q1, 350, but taxable sales are only 100,000 through Q3, and then 50,000 in Q4. 2019 taxable sales of 350,000. That's the total for the year. That's Q1 through Q4. When do you have NEXUS? Same time, Q3. Taxable sales doesn't matter because Texas measures based on gross revenue thresholds. Like David was referring to, some of the states refer to taxable revenue thresholds. So in those states, your taxable sales will matter. But as we mentioned, and we emphasized, when you have over 100,000 in sales in a state, consider sales tax. Consider whether or not you are required to start filing. So, polling question. Who are the 2 and states? 1, Colorado and New York. 2, New York and Connecticut. 3, Connecticut and California. 4, none of the above. 67%. New York and Connecticut. That's correct. So I'll just talk about the next slide, and it has to do with reporting and collecting. There are 5 states that still have these, as David mentioned, these old historic notice and reporting rules. Why were they in place? This was another way for the state to get around the physical presence NEXUS standard before 2018. It was a clever way because the state basically applied these onerous requirements to, and some of those included, taxpayer had to put a notice on the website that use tax may be due on purchases. It might have to send a transactional notice to certain tax customers, for instance, that had purchased over $500 in dollars in goods that use tax may be due. They also might have been required to send an annual notice to the state listing the buyers who owed sales use tax. So given all of those requirements, the retailers were basically forced to update their websites, do all of this record keeping, to force them to register and file, because that would have been easier than trying to comply with all these reporting rules. So there are onerous penalties attached to this. Of these states, there's probably only a couple that still have these penalties attached. But these laws essentially are not in play, and going forward, just think taxpayers should be thinking about filing and collecting. So I'm forwarding the slide, and the next few slides talk about marketplace facilitators, and those apply to Amazon. Amazon is a marketplace facilitator. The key features of a marketplace facilitator is one that lists or advertises the item for sale, collects payment, Amazon collects payment on behalf of the marketplace sellers, transmits the payment to the seller, and has an agreement with the seller to do so. There are various versions of marketplace laws. With no exception, marketplace facilitators collect and remit the sales tax. There's a waiver process where the sellers can opt out and do the collections on their own, or they would register and they can opt out, and there's a waiver process where the third-party vendors can go ahead and register. So these are the states, these are listed on Amazon's website, are the states in which the Amazon will collect on behalf of the marketplace seller. So there's 45 states that have a sales tax, and 39 of those require the marketplace to collect tax. The remaining 6 are ones in which the remote seller has to file on their own. So are the states hunting remote sellers? David, I think this is one of your favorite categories, so I'll have you discuss this.
All right. Fine folks in California, they subpoenaed Amazon's inventory records a year or so back. Technically, if you are sending pallets of goods for fulfillment by Amazon, you may be shipping it to one location. Of course, then Amazon moves it around as needed to increase your sales. But whatever that you are selling on Amazon, when that material is sitting in California, it's still your material. It may only be $1,000 worth sitting in an Amazon bin somewhere. But because you had your property in California, you created physical nexus. And they are hunting people for that. Massachusetts was doing the same thing. I think New York was. North Dakota and Texas and a few other states have been cross-referencing different types of returns to see if you've been playing in their state. Texas is cross-referencing franchise tax returns. As a franchise tax, you have to file, even if you've never been there, you just have to have large enough dollar amounts. So Texas is presuming if you are filing franchise tax, you maybe should have a sales tax permit. North Dakota's been cross-referencing payroll records, just looking to see if you had a remote employee working here. Texas recently is requiring manufacturers of ATVs of various varieties to provide them a list of warranty registrations coming from within their state. As you can imagine, someone might buy an ATV somewhere and not pay any tax on the state where they got it because it's going out of state or for various reasons. They register their warranty, and because of where they live, they just never register it and they just never pay tax on it. Well, Texas is now hunting those individuals. And what is our next one is income tax. That is definitely for high risk.
I'm happy to take that on, and since we're running short on time, I think I'll cover 2 more slides to all of you. You have the presentation. If you have any questions, be happy to answer them afterwards. So as we navigate, one of the things I wanted to touch upon is, in addition to sales taxes, other states certain states, I should say, have gross receipts taxes. And one of the new ones is the Oregon corporate activity tax. And as I work on changing the slide, this was effective, the corporate activity tax was effective January 1st of this year. And if you have sales of over $750,000, you must register within 30 days or face penalties of up to $100 a month to total of not to exceed $1,000 a year. So the first quarter payments are due April 30th, and that's why I'm highlighting that. If you have sales over $1 million, though, you must begin filing and making these payments. The tax is approximately 0.57% of your gross sales in Oregon. And the last slide I'll show you is for Eide, what we do is we put together a diagnostic on the sales and use tax, and we do this on the income tax side as well, where we do a high-level assessment of where your company may want to file. So that is one of the ways that we can help you. But again, any questions that you have, we'd be happy to answer them after this presentation. So now I think I'd like to hand it over to our technology team.
All right. So I'm going to talk briefly about how an ERP system can help with your business processes, including tax collection, through some of NetSuite's functionality. So one of the great things about ERP systems and NetSuite as well is that it's a really great way to automate your business processes. You can essentially track from the sale to the fulfillment. And it's a unified suite to manage customers, projects, billing, procurement items, and reporting. And it's going to eliminate annual bottlenecks from using like multiple different systems and bringing them together. It has embedded business intelligence with real-time dashboards, alerts, and analytics, a built-in workflow that automates processes and orchestrates approvals and enforces rules. And it's just a single source of truth for all master records and transactions, all maintained within your ERP. All right, so I want to get in a little bit about how NetSuite tracks and collects tax, and it can basically be maintained on both the item and customer records. So you can basically determine whether the item is taxable or not, or the customer is taxable or not. And NetSuite also hosts a variety of native tax tables that includes tax codes and tax groups. It's also good for audits and controls and can assist by capturing the system notes and audit logs so you can determine who's done what, whether it was through an integration or a user. ERPs can also provide better visibility into analytics by bringing real-time reporting to dashboards and KPIs to user dashboards. So for instance, with tax collection, you could be able to track your customers or sales by volume and set an alert to notify you when you hit a certain threshold if you set up those rules based on sales tax laws that Iris touched on earlier. And then finally, document retention is another great thing about ERP systems, and the ability, an example for NetSuite, a file cabinet, and you could lock down who can see what records. So tax exemption certificates could live here for your customers. They could also exist on the customer record as well if you wanted to do that. And it's a nice single point master record to host all your business documents. All right, so third polling question, true or false? An ERP system can help with building in a workflow that automates processes, orchestrates approvals, and enforces rules. Great, everybody got it right. Okay, so I want to hand it off to Bridget at Avalara to explain how Avalara can help you become more tax compliant.
Okay, great. Thanks so much. Okay, I'm Bridget with Avalara, and you know, we learned so much about these sales tax changes that have been going on for the last couple of years and the changes this year. So what does that mean for you and your business, right? How is this affecting you? As you can tell, managing sales tax continues to grow more complex right? Before, if you had physical presence and you were selling into states, you didn't have to worry about collecting there. But now your business is more likely required to collect and remit sales tax in more than one state, now that this economic nexus law is in effect. And as you can imagine, managing sales tax compliance across all these states is much more complex than it was if you were just in one state or even a couple of states. And what Dave and Iris pointed out, you know, is there's different rules in all of these states. And I'd like to point out too, more than 17 states include exempt sales in economic nexus thresholds. So even if you're not calculating sales tax, you need to have exemption certificates now in those states. And that brings on a big problem that people, you know, normally don't think about. If you're not calculating or collecting sales tax, maybe a lot of people are like, oh, we're exempt, that doesn't matter for us, but it absolutely does now with these new economic nexus laws. So, you know, as Kelly was saying, why should you automate sales tax? Really, it's more accurate and efficient. You know, if you had, or if you were responsible for handling sales tax in just 1 or 2 states, you were probably able to do it. It might not have been totally accurate, but it, you know, it was probably okay. But now moving into more states, it's just not time, it's not time well spent to be dealing with all the sales tax and the filings, right? Risk management, automation really mitigates that risk management. Your customers are happier because it's easier to collect their exemption certificates if you automate it, or if you're calculating sales tax, you know, you're charging that right rate. And this really frees up time to let your business grow. And that's what we're all trying to do here, right? Is to grow our business. So we have a suite of solutions. CertCapture handles exemption certificate management. Avatax handles the calculation, and that's usually sold in with our returns console that will automate the filings. So a lot of times if you're automating your payroll, it's very similar where you would just like automate your sales tax process as well. So why Avalara? What's unique about us versus NetSuite that we were looking at? We have 700 pre-built integrations. I think the importance about this is what Dave was talking about, right? Someone is selling at their store, and then now they're also selling on a website. And because of that, you're probably using an ERP like NetSuite, and maybe a separate e-commerce solution like Shopify Plus or Magento. And one of the key differentiators of Avalara is that it can integrate through all of those systems to give you an accurate rate the whole way through and still file on one return. Avalara is designed for global commerce. We have a new solution out called Cross Border that's sold standalone that can automate those duties and taxes that you might have if you're selling across borders, right? Avalara calculated 9.5 billion tax engine calls last year, and we processed 36 billion returns, right? So we have this down. We have to be right, or you can imagine the millions and millions of businesses that we would hear from. Our data is so accurate that many states use it as their own sales tax database, right, to make sure they have the right rates as well. So really quickly, and I know we're short on time, so I'm going to kind of fly through this, but one thing I really want to point out is our economic nexus monitoring functionality that we have. So I'm going to skip ahead here a little bit to get to that. And we used to charge for this economic nexus monitoring, and now it's included in the solution. So if you're using Avatax and you're only registered in a handful of states, but you're worried about moving into these other states and, hey, have I hit this threshold yet? Our solution will actually notify you and say, oh, I see in Alabama, the threshold is 250,000 and right now you're at 200,000. Like, you might want to get registered there. And then when you hit the threshold, it'll notify you again. So I think this is really important new functionality that will just help make everyone's life a whole lot easier. Okay, I'm going to get to the polling question. What can automated sales tax management can provide your organization with? I was going to say, if anyone has questions about Avalara after this, feel free to email me and I can send you tons more information on our solution. Okay, great. Really fast, I want to touch on the Streamlined Sales Tax, SST. And this is how you can get free sales tax. Yes, free sales tax services in 24 states. You do have to qualify for this, but I think just to mention the major change that happened is you used to have to be selling into all of these states to leverage this service. And last year they changed this where if you're just selling into one of these states or two, and just say you wanted to register in Washington, Nevada, and Utah, you can do that, and then you don't have to register in the other ones. So this is a great service that, you know, it's been around for a long time, but that change has made it more accessible to a lot of companies. Avalara is a certified service provider for this free solution. So you actually do not pay Avalara for calculations, registrations, or returns. And there's actual audit defense as well. And if you want more information about this, let me know. You do have to qualify. But this was an effort by the states to make, you know, compliance with the economic sales tax law easier for everyone. So you do need to be a volunteer seller in order to get this. And we have lots of information about this on the Avalara website as well. Just talking about those changes, the future of SST, a few states that aren't part of this are developing their own CSP program, like Pennsylvania, Connecticut, Illinois, and New Mexico. So something to keep your eyes on if you're selling into those states as well. I'm going to quickly wrap it up. Everyone thinks of Avalara as sales tax, I hope, which is awesome. We are, you know, world-class sales tax automation software company. As I mentioned, we also have a new cross-border solution that will manage all your challenges with customs duty and import tax. How I think of that is, let's say you buy something on Amazon and it comes from another country and it comes to your house, and all of a sudden you owe $20 to the post office to have this package delivered, and the package maybe cost you $5 and you're like, I would have never ordered that. With our cross-border solution, all of those charges, those taxes and duties fees will happen like at the same time as the sales tax rate. It'll happen in the cart. So your customers will know what they have to pay at the point of purchase rather than waiting until it comes to their house. So I think that's a really high level overview of what that solution does. We also have that solution as well. And PITMASTER, if you're a company with thousands of UPCs, we have a solution that can help you map that. We have a fuel tax, excise tax solution as well. I'm going to build out this slide that can help with all of your excise taxes. And a communications tax solution. Eide, one of their communications clients, purchased our communication solution last year. So something to know if you're in that field. And if you have your own personal vacation rental, you could do your rental tax filings with My Lodge. Really affordable, more on a personal lodging tax solution. So with that, we'll get to the last polling question. Avalara can prepare all state and local registrations or licensing forms. True or false?
Okay, so Iris and David, do you want me to start reading some questions, or should we answer these offline?
I'm happy to address a couple of them. I can say the ones I see. Could the vendor suggest to the customer that they pay use tax to avoid registration? So this goes to a notice requirement, and in most states that's not the case. The vendor would need to register. We had discussed, the reporting and notice requirements are only in a handful of states. Would drop shipping to customers be considered, would that business be considered a remote seller? Yes. So then it would be where the remote seller would end up charging tax. Usually it's at the point of the customer receiving the product. In that state, that's where the remote seller would be required to register and file if they were to exceed the economic nexus threshold. So how does it work if we purchase an equipment in Minnesota and have them drop ship to a New Mexico customer? So typically the sales tax would be determined based on where the ultimate customer receives the product. So that's how the sales tax collection would be determined. If that doesn't answer your question, feel free to email me. I'd be happy to follow up and provide more detail. Amy, were there additional questions?
Yeah, there's about 10 more, but it looks like a lot of us do need to jump on some other conference calls. So for all of you who did ask questions, thank you so much. I'm able to pull a report. It will have your email address in there, and we will answer those offline. So we'll be in touch with you this week regarding all of your questions. Thank you to everyone who did participate today. And a reminder that if you did participate in the polling questions, we will email out your certificate within 10 to 14 days after this webcast. So thank you to Bridget and Iris and Kelly and David, and I hope everyone has a great day.